Good morning and welcome to this Wednesday, January 25th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we stalled a little bit yesterday, but certainly rolling over today in futures, pointing that out rather clearly. Last check, and this was a few minutes ago, futures were down. Dow futures down almost 300, S&P 500 futures down 44, NASDAQ futures down 200. So on a relative basis, NASDAQ definitely getting hit harder. That's where we've seen most of the gains so far in 2023. But the Microsoft report yesterday, along with Texas Instruments and a few others, not really looks like in the short term anyway, not allowing the stock market, the S&P 500, to break out above that key trend line that we've been talking about for some time. And I'll go through the different time frames on the S&P 500 and show you what I'm seeing. But throw in Intuitive Surgical, ISRG in the medical equipment area. Just not a very good night of earnings. And to be honest, the market's been saying this. I really think this is not going to be a good earnings season. But fortunately, the stock market looks out 6 to 9 months. I think a lot of this has already been priced in. But we shall see what happens. I think this next move to the downside is going to be the critical one to determine whether or not this truly was just a cyclical bear market or whether it's something deeper. I think how far we go down on this move, I think is going to tell the tale to a large extent. Anyhow, let me go ahead and share with you a couple things so we can get started. I also want to mention that crude oil prices are flat this morning, still sitting right around that $80 a barrel level, and the 10-year Treasury yield down a little over a basis point back to 3.45%. So we are moving back down in the Treasuries closer and closer to that key 340 level. We did have one close below 340. I think we finished 337. But other than that, 340 has been the level. So that's kind of what I'm watching. Certainly a move back below 337 would take out the recent lows and suggest further buying in treasuries, which would then send the yield down further to the downside. Over at earningsbeats.com, a couple things I want to mention real quick. First of all, we have our first ever live trading room this Friday. I'm going to start it off on Thursday evening at 7 p.m., just going through some of the things that I look at from an overall perspective in the market. Also trying to detail some of the areas that I want to be looking at on Friday. So again, it all starts on Thursday at 7 p.m. We'll get out more details. I thought Friday was starting at 8:30, but maybe it's going to be 8:45. We'll let you know here over the next couple of days. In order to be eligible for this trading room, though, you do need to be an annual member at Earnings Beats. If you are interested in starting a trial so that you can kind of see what we're all about here over the next couple of days, you can click on that button there, start your no-cost trial. That's a 30-day free trial. You do have to provide a credit card so we can get you set up in our system, but we will not charge you until after your 30-day trial is complete. And we will send out an email to remind you. We will not just charge you. We will send out an email before your trial is up, letting you know that you're going to be charged to make sure that you are comfortable with that. If you do sign up for the no cost, decide you want to come into this trading room, you will continue to receive your 30-day trial. The annual membership plus any bonus will be added to the end of your trial period. So you don't have to worry about coming in for a day losing your 30-day trial. You won't lose your 30-day trial. You'll get that, and then your annual will be tacked on top of that. Down below on the homepage, one way to get to know us even better if you're new to the show and to Earnings Beats and to my approach to the market, you can subscribe to our Earnings Beats Digest. It is completely free, no credit card required on this one. You can unsubscribe at any time. It's a 3 times a week newsletter, Mondays, Wednesdays, Fridays, usually out about an hour before the market opens. just your name and email address. That's all we need. So that's a great way to begin to understand how we approach the market. Again, if you're new to Earnings Beats, that's what I would recommend. It's a 2-paragraph, 1-chart kind of a newsletter. It's very quick and easy. Just little bits and pieces of information about how we approach the market, potential trades, if you're so inclined. That's completely up to you. But a lot of times we do focus on individual stocks, and if you like them, feel free. Again, that's completely up to you, whatever you want to do. But anyway, just wanted to mention, so go to earningsbeats.com, check out the free newsletter. Also, again, live trading room on Friday of this week. Lots of earnings coming out. Figured this would be a great time to go through and talk through a lot of the different strategies that I use in my trading. All right, moving on to what happened on Tuesday. It wasn't a bad day. It wasn't a good day. It was just a blah day. We started the day a little weak. We came back, we rallied. The Dow, a little bit bifurcated. The Dow went positive. S&P was pretty flat. NASDAQ stayed a little bit weak. So there was a little bit of rotation, maybe ahead of some of these key earnings reports like Microsoft. But overall, I mean, there really wasn't much change. You can see the Dow was up 100, S&P was down 3, NASDAQ was down 30. So on a percentage basis, Dow up 0.3%, S&P down less than 0.1%, NASDAQ down 0.25%. Mid cap, small caps, both down about 0.4%. Moving on to the sectors, industrials were your leaders was the leader on Tuesday. Industrials up 2/3 of 1 point, which also happened to be 2/3 of 1%. Utilities up about 0.5%. Real estate 0.4. Staples 0.4. Notice staples, real estate, utilities, all three defensive groups. And then the worst performer was another defensive group. That was healthcare, which lost 2/3 of 1%. So we had kind of a mixed market where we saw a number of sectors higher, number of sectors lower, some of the major indices higher, some lower. It was just a period of indecision. On the short-term chart, we had some nice bullish setups that will not execute because of the poor futures this morning. But, we move on. We take a look off of the 60-minute chart, and we take a look more at the daily chart now for some key support levels, and we'll get into that in just a minute. First, let's take a look at the 10-year Treasury yield. Here you can see we are moving lower. Let's get a quick update here, make sure we got the latest. 3.45%. Went up to the 20-day, failed. Now we're starting to roll back over again. As I've mentioned, I'm viewing this as a double bottom. So I think we're in a trading range. 337 was the low here. So let's use that as your bottom on the 10-year Treasury yield. And then the high in between this double bottom was up at about 390. So that's the trading range for now. Anything goes for me in this range, although we are trending lower. So I suspect we're going to break down. That's in line with what I think the bond market's been saying, what I believe is going to happen, which I think rates go lower later this year. I think the Fed backs off of its plan. I believe we're going to see continually deteriorating, lowering inflation numbers. I think the annual rate, core inflation, or the core inflation rate, when we look at the CPI, I think that continues to go lower and lower and lower for the next few months. And so I think the Fed's going to get its series. I think it's going to start moving back toward, it's going to take a while to get back to 2%. Don't think that's going to happen this year. I suspect it'll happen sometime next year. But I think as we work our way back down in that direction, and it looks sustainable, I think that's going to give the Fed the opportunity to address the economy. And as we saw with some of the earnings reports last night, what I think we're going to see throughout this earnings season, earnings are not good. We saw a lot of deterioration in the economy in the fourth quarter. So I don't expect numbers to be great. We'll see some companies beat, but I think by and large, most companies are going to miss. And that's going to bring out all the recession bears and all the, oh my gosh, the PEs. Look what's happening to the PEs, those bears. But the market prices everything in looking ahead. So if you're stuck looking at what's happening in the moment, I think you're not going to be looking at the right things, my opinion. All right, let's move on to the S&P 500. So here's a monthly chart. So let's take a look from a monthly perspective. Looks like an uptrend to me, which is why I keep saying this is a secular bull market and a cyclical bear. Here was your cyclical bear. That was a very quick drop, and that was the pandemic of 2020. Here was a cyclical bear market, 2018, the trade war. This was a correction back in 2015, early 2016. More corrections here in 2010, 2011. There, of course, was the end of the secular bear market in 2009. But if you notice as we move up, one thing that's been consistent for about 12 years now, we have not had a monthly close below the 50-month moving average. Went down and tested it in October, did not close there. We have not had a monthly PPO below zero. One of the things I said throughout 2022 is you can't call a secular bear market until you get a negative monthly PPO. Doesn't mean you're necessarily in one, but there has never been a secular bear market without the monthly PPO going negative. Never. There's never been one. We had the PPO after a huge rise for 2 years. That monthly PPO was as high, well, almost as high as it's been in the last 75 years. We needed what we had in 2022. We got the sell-off. We got the cyclical bear market. We got the 50-month test, very similar to what we've seen during other periods of cyclical bear markets. And I think we go higher. So when I look at the long-term chart, I'm bullish. I see this as an uptrend. I see it as a successful 50-month test, and we'll see what happens. Now, could I be wrong? Sure, I could be wrong. We might go back down below that 3,500. We may lose that 50-month moving average. And if we do, the odds of this remaining a cyclical bear market go down considerably. Are they eliminated? No, but they go down considerably. Next up, the weekly chart. The weekly chart, I can look at this chart and agree with the bears out there. We're in a downtrend. We have been. Just here over the last couple of days, I've been talking about a major test of a trend line. This is the one I'm talking about. You can see the S&P 500 right up to the 50-week moving average, where we have struggled for the last many months in this downtrend. The 50-week moving average right now is at 4,030. Yesterday's high was 4,039. Couldn't close above it. Of course, the week's not over yet. It's a weekly chart. We'll see. But based on futures, it certainly looks like that was probably the only test we'll get this week, but you never know. I see a couple of differences here on this chart that I think are starting to look more bullish, but we don't have the confirmation. Here on these moves to the downside, when we've had bounces, we tend to go right back down without much of a bounce. Go back up, hit the 50-week, down, can't get back through that 20-week moving average, go to a new low. Every one of these times we go to new lows, really don't put up much of a fight in the move to the downside. Here, on this last move up, you can see actually we pulled back. It looked like we were going to do maybe what we had done before, but we didn't. We didn't keep going down. Instead, we turned back up through the 20-week moving average again. Does that mean it's over? No, it's just a little bit of a character change that I think you need to be aware of. To the downside, 20-week moving average, 39.32. So that from yesterday's close, about 85 points lower on the S&P 500. We're probably going to give up half of that at the open today. Probably somewhere going to be around 39.80, 39.70 maybe. That's what I would be looking at. And we'll see if that 20-week holds. If we get through, hold the 20-week on this pullback and we go right back up through the moving average, it's going to be hard to argue bearishly. And if we don't go through these levels, it's going to be hard to argue bullishly. We're going to probably be in this no man's land for a period of time until the market decides which way it wants to go. So the monthly chart to me looks bullish. The weekly chart to me looks bearish. Just looking, forget about all the other signals that I look at. I'm just talking about price action. Price action on the monthly, I think looks good. Price action on the weekly, I think looks bad. And that brings us to the daily, where we're kind of in between. I mean, we're seeing these moves below the 20, back above the 20, above the 50, back below both, back above both, back below both, above both. Nice little rally there in November and December. Back below both, up above both, back down to test the 20, back up above both, below both, above both. And now I don't know where we go from here. My point is, when you cannot hold moving averages, you are in a trendless market. So that at this point is what I would call this. Now, again, I'm just talking about looking at the price action alone, not looking at anything else. I see a trendless market right now on the daily. I see a downtrend on the weekly. I see an uptrend on the monthly. We pull up hourly and really get into a more short-term picture. We had a nice breakout on the S&P. Pulled back, got the 20-hour moving average, been holding that, but that's at 39.97. Unless things change quite a bit here in the next 15 minutes, I don't think we're holding this 20-hour. I think we're going to go back below it. And the problem here is if we pull up the diamonds, I mean, we had a nice uptrend followed by a cup, little handle. That looked kind of bullish in the short term to me. Looking at the Qs, QQQ tracks the NASDAQ 100. I saw an uptrend. I see a bull flag. I see a flagpole. You can connect the highs coming down, connect the lows going up. And I see a little bit of a flag pattern here after an uptrend. That's bullish. The problem is, just like when you see a topping head and shoulder pattern, it doesn't confirm until you get the breakout. Doesn't look like we're going to get the breakout on the QQQ or on the diamond. So at this point, I would say the short-term hourly picture takes a little bit more of a turn to the south, a little bit more negative. I doubt, well, we got the 20-hour at 286. I think the Qs, let's just see where they're trading. I think they're at 284 and change. Oh, 283. So we are now down 1.5%. So yeah, we're not holding that hourly, that 20-hour EMA. 283 puts us down in here, closer to the 50-hour moving average, maybe getting closer to this trend line test. And this is something maybe to keep an eye on. Let's annotate this. What I like to do is just kind of connect the highs, which you can see that line connects multiple tops coming across here, probably at least 4 or 5 different points. And just drag this back so that the other, I'll make sure my other line's long enough. And if you notice, if you drag that same sloped line down, it connects almost beautifully to the lows. Now, I think this channel is important for a couple of different reasons. But number one, notice we've got right around 280 as our support area. The 50 hours at 281 and change. So you got a couple things to watch for there. But if I exit out of here, just remember that bottom channel line's at 280. If we pull up a daily chart, look at where our moving averages are, the 50 and the 20. They're both rising. The 50 is at 278.73. The 20 is at 277.48. But again, both are rising. So if we work our way back, it doesn't have to be today, but even over the next few days, as these moving averages are coming up and price action goes down, it could be that that channel right around 280 becomes a fairly key area on the daily chart as well. And I'll be honest, Microsoft was a company that on a relative basis, I didn't really like. I mean, I didn't hate it, didn't like it going into earnings. If we pull it up, look at the relative strength here. Here's Microsoft versus the software. I mean, it's been coming down for the last 5 or 6 weeks, but look at really the whole last year. It's just not been doing much relative to software. It's not a leader. And so that's a little bothersome. The other thing that's bothersome is today, after the close, we're going to get another high profile company that I'm going to be surprised if they report anything positive. And that's Tesla. No, that didn't work out so well. Let's try it again. There we go. So looking at Tesla, here's your downtrend. I mean, yeah, we've had a bounce, but the bounce was off of this huge move here. I mean, we went straight down from almost 200 down to 100. So we bounced back up $40, which is nice, but Tesla is by no means out of the woods. I wouldn't be surprised to see a big hit to Tesla after the close today. Wouldn't be surprised at all. Look at the relative weakness, Tesla versus the automobiles. This is a very steep drop and a lot of selling. Now, some you might look at that and say, well, it's capitulatory. It's very heavy. That could be the case. The other thing you have to consider, though, is this is share volume. Dollar volume probably wasn't that capitulatory because here price action is much lower than what it was over here when we were going up in July and August 300. When you're trading down here closer to 100 or even 150, the volume needs to be twice as high in order for the dollar volume to equal what it was at 300. So these were 100 and 125 million share days. So 200 to 250 million share days at $150 would be about the same. And that's about where we were. So this volume, and this is the one thing I don't like about share volume. I like to look at dollar volume sometimes. We don't have that option just yet at stock charts, but it's something that I've asked for a lot. And that's because when you look at a chart like this, you say, wow, the volume is really off the charts on the downside. But if we did dollar volume, I'm not sure this volume's heavier than the volume on the way up back in July, or the volume on the way down back in April and May. It just looks like it. It's a mirage. So you got to be thinking about that. Anyway, I see a move down, a rebound, and I wouldn't be surprised by a gap down with earnings. I hope I'm wrong. And I really like Tesla long term. I've said that all along. I mean, I think if you buy and hold this stock for 10 years, I think you'll do very well. And this will be a blip on the radar. That's my opinion. Some of you may disagree, and that's fine. But Tesla is one of my favorite stocks for the long term. But in the short term, you know, it's based on a lot of growth. And when the numbers are coming down, the estimates are coming down, and they're lowering forecasts and so forth, growth stocks are going to get hit hard. When they start to raise again, you'll see them move very quickly. They're not like these value-oriented companies that have more book value and are somewhat, they have a higher floor, but a lower ceiling. That's what value stocks have. Higher floor, lower ceiling. Growth stocks have a lower floor, but a much higher ceiling. Just depends what market you're in. We have not been in a market for the last year that's been very kind to growth stocks, and for good reason. The market has been pricing in a recession. The market's been pricing in the effects of inflation, the higher interest rates. But now the market is going to be looking out 6 to 9 months. What does the market see? That's what we're going to be dealing with, I think, here over the next couple of weeks to a few months. All right, let's talk a little bit about bear markets. I think I did some sort of a anatomy. Yeah, actually, it's got the date right here. I did anatomy of a cyclical bear market all the way back in February. This was right after the weakness started. And I went through and I highlighted to everyone, this is what bear markets look like. This is what we should be expecting in 2022. So I did it well in advance of all the, all the media getting involved, because there were a lot of signs out there that suggested we were going lower. And, I know a lot of folks listen to me and think I'm a perma bull. I'm not a perma bull. I'm a bull most of the time because the market goes up more than it goes down. I think it's dumb to be a perma bear. Look at a long-term chart on the S&P 500. How can you be a perma bear? But there are lots out there who just always think the market's going down. I will tell you when I think the market's going down. Again, doesn't happen often, especially in a secular bull market. You have maybe 3, 4, maybe 5 times over a 20-year period where you really need to be cautious. And we've gone through a lot in this decade, the past decade, even last 2 decades. So we've had reason to see some significant drops, and we've seen some drops, but the overall trend remains higher, as I showed you on that monthly chart. There's that monthly chart. These were scary times. Every one of these drops to the 50-month moving average were scary. And they were all drops where everyone was thinking the sky was falling. Every single one of them. And we just kept going higher. So let's take a look quickly at the bear markets. Here's the 1950s. This was a correction in 53. There's a bear market. That one lasted 3-4 months, was done. We move on to the 1960s. By the way, 50s and 60s, these were both part of a secular bull market, long-term bull market. Cyclical bear markets do show up, though. 29% in 62, 24%, 66, 20%, just as we were getting ready to head into the 70s. In the 70s, now we're into secular bear market. This is what it looks like. Really lengthy decline, horrible. I mean, this was the rest of that 69 decline into 70. So that was step one. Then you go up for a couple years, kind of think, okay, it's not that bad. And then you have the big drop. Then we start to rally. Of course, we don't break out again until the 1980s, which is next. What happened? 1980s, 1990s, we had another secular bull market. Here are the 1980s. So we break out at the end of 1980. We had a 28% decline that lasted 20 months, close to 2 years, probably maybe 21 months, 21 months, 28% decline. And then we went up. This right here, 83 and 84, kind of looks like 2015, 16, something like that. Anyway, kept going up. And then what happened in 1987? Looks a little bit like the pandemic, right? Down 36% in a month. And then right back up again. How about the 1990s? This was the Persian Gulf War. Went down for about 4 months, down 20%. 1998, 3 months, 22%. Then we move into another secular bear market, the 2000s. Big drop number one. Then there's that big rise, making us think it's all over. There's drop number two. That's kind of the signature of these secular bear markets. You got 2 big drops. Usually one time will be 40, 50%. The next one, at least that as well. You just go through a long period where stocks are out of favor. Then we start rallying off of it. So then what happens? The 2010s happen. We had a couple of drops here. I could have probably marked these. This one, 13. That was pretty close to 20%. Let me annotate this. I probably should have added that. It's coming out of that secular bear. The market was still really nervous, but it probably still makes sense to let's just see. May not get it exact, but I'll be close here. Yeah, about 22%. Technically, that was a bear market. The main reason I don't include this as a bear market when I talk about bear markets is that we never set a new high from the last bear market. So remember, the high on the S&P was at 1,500, 1,550 back in 2007 and 2000. So here we did drop 22%, but we did it from the 1300s. So it wasn't from an all-time high. I like to calculate bear markets from highs, from all-time highs. Anyhow, here was a correction 2015. Here was a 20% cyclical bear market over 3 months in the fourth quarter of 2018. And let's go ahead and save that. And then the 2020s. Here was your pandemic, 35%. And here is a 27% move down over about 9 months. I believe it's all still part of the secular bull market. That's what I've talked about for many, many, many years. that these moves to the downside, we still have interest rates. 10-year treasury yield is under 3.50%. What asset class is going to take over? Bonds? I do like international stocks. I think international stocks look better to me than the S&P, but I don't think international stocks are going to go up without the S&P going up as well. At 3.5%, this is a really good environment for stocks. Now, some of you might think rates are going up to 8%. I don't know. If you do, good luck. I don't think that's happening. I think we've already topped in the 10-year treasury yield. Maybe not in the Fed funds. I think the Fed, they've seemed very adamant about raising. I'm sure they're going to raise again at the end of this month or beginning of February. But the 10-year treasury yield, these investors are ones that worry about inflation. They will not accept 3% yields if they believe inflation is going to be 6 or 8%. So anyhow, there is what I think is your cyclical bear market of 2022. We'll find out. One thing I didn't point out, but as I mentioned, if this turns out to be the low in the bear market, it will be the 7th time in the last 14 bear markets that it ended in October. Pretty high rate of bear market failures or reversals in the month of October. 7 out of 14, pretty high. But let's see what happens. We got Microsoft reporting. The market just opened. I will show you a couple of these charts real quick. Companies that reported earnings last night. So let's take a look at Microsoft. And there's your drop right now, down $7, over almost $8, more than 3%. You got Texas Instruments. Didn't like this report going in. It's only down 0.25%. We'll see if we can get the breakout at some point, but not yet. ISRG, this was not a good reaction. Big drop there, 6%. CNI, so this is looking at the railroads, dropped down to test recent price support. We'll see if that holds. FFIV, I did not like this one going into earnings. It gapped down, but maybe, just maybe, we'll get a nice little recovery here. I thought if we gap down closer to 134, 135 without breaking down, that maybe we would get a reversal like this on FFIV, but I didn't like the overall chart going in. One stock I did like that I thought was going to report great numbers, and they did. They looked like they were going to gap up, but I would not chase the rally. I think we could get a pullback here at some point, and that is AGYS. We did not get a breakout with the good news. I wouldn't be surprised to see the stock down the low to mid 70s. Because now the news is out. So the stock already had a big run up, and now the news has come out. We got a negative divergence in play. We could not get the breakout at the open. I think we're going to see a sell-off here on AGYS, just my own, gut feeling. But those were some of the earnings. I know this morning we had GD, which was General Dynamics. They beat, but the stock down anyway, down $10. I like GD going in. I thought in pre-market it was up around 240, but maybe they said something in a conference call. But that's down. Let me see what else reported. ASML was a semiconductor that I liked going into earnings. I thought it looked pretty good. It's down 1.7%. They did beat, by the way, earnings, and so did General Dynamics. Boeing, another one. They had a big miss on the bottom line, but they missed by a lot, which makes me think it might have been a one-time thing. The overall price is holding up pretty well. Looking for any others. Abbott, I thought looked pretty decent going into its report. It's down. Just seems like a theme. Everything is down with their earnings. But the key, like I said, is going to be to watch the QQQ, for me anyway. That 20-day moving average, which is now down at 278, 50 days at almost 279. I wouldn't be surprised if we head down that way, especially with Tesla coming out after the close today. And then we'll see what the market's made of. Anyhow, I'm running a little bit over. Let's quickly see what the market is doing. Dow down 231, S&P down 47, NASDAQ down 198. So clearly the NASDAQ getting hit harder on a relative basis. Watch the VIX. VIX up about almost 5%, back up over 20. If the bears want to get things going, the VIX needs to keep rising. If this starts to dwindle, goes back down below 20 and moves lower throughout the day, I just think that's a sign that market makers are not expecting prices to go back down again, because that's basically how the VIX is set. It's based on the premiums on the short-term S&P options. And so as the VIX goes down, the premium on the options goes down. If you know anything about the pricing of options, premiums don't go down if the market is anticipating a drop. If the market's anticipating a drop, premiums go up. So anyway, keep all that in mind. And again, we got that big live trading on Friday. If you're interested, make sure you are a member, sign up for the trial. And then if you want to come in, you do need to sign up for that annual membership. Anyway, that's it for me today. Have a great day, everybody. I'll be back tomorrow over at Stock Charts TV. Just go over to Stock Charts, click on that link I'm pointing to right there at 9 a.m. and you can tune in. Have a great day, everybody. Happy trading.